Hello, hello, hello. Welcome, ladies and gentlemen. This is the Build and Grow with Real Estate show. My name is Judah Hoover, and Josh Weidman will be joining us shortly. We come to you every day at noon, and we discuss real estate related topics for both the real estate investor and the service providers of the real estate industry. So whether you're a buy and hold guy, whether you're a flipper, whether you're a wholesaler, a lender, an appraiser, a realtor, or anything else like that, this is the place for you. Josh and I have both been doing this show now for about 6 months. This is show number 138, so you kind of get a feel there for what we've been doing. And we absolutely love coming to you every day. And what we need from you guys is comments, likes, and shares if you like what we have going on. And that is very much appreciated. The other thing that we want to talk to you about right at the beginning of the show is the importance of going to buildandgrowwithrealestate.com, buildandgrowwithrealestate.com, and getting registered for our 5-day Facebook challenge that we are going to be doing next week, delivering a whole bunch of content, giving away free prizes every day. And the whole point of that is going to be the 5 days to flipping your first deal, 5 days to making money in real estate without credit, cash, or criminal behavior. 5 days we are going to meet every day, and we are going to take meaningful, actionable steps to getting you to the next level in your real estate investing career. It's totally 100% free. And it's just a way that Josh and I are going to be able to deliver more and better content in a more concentrated way. So without further ado, Josh, let's why don't we jump into
without further ado. I mean, I know I'm late to the show. Judah gets started. He's hogging all the limelight. You know, what can I say?
Sorry.
All right.
I love the limelight, by the way.
I know you do. I know you do. So I am not a big fan of cap rate. And today we're going to be talking about why it sucks. What is the cap rate and why it sucks, and why what you should know about it. Man, it would help if I share my screen. I got too many buttons. That's what I'm realizing, Judah, is like now that we have touch screens, everything's a stinking button anymore.
Right.
You know? All right, so here's what we got. Boom. Cap rates and why they suck. Look, I don't know about you, but I've gotten emails from wholesalers and even real estate agents with investment properties in them. And it's like, this thing's a 15 cap. Everything's in capital letters, you know, explanation points, making a meme or an emoji in there. But the bottom line is, cap rates are a good way, like so many other things in real estate and databases and stuff like that. It's only as good as the data entry. And
garbage in, garbage out.
That's exactly right. And so, while cap rates are a good way to get a high level view of a property, if you're comparing multiple properties, if you're preparing the cap rates, it's a great way to analyze them. But if somebody else is, really the devil is in the details. I mean, the secrets, there's all kinds of secrets hidden in there. So without further ado, let's jump in here and take
Steve,
a look.
hey, maybe you can tell us what CROCI is. COCRI. I would love to have an explanation on what that is, my friend.
I'll bet it ends with return on investment. Cash on cash, return on investment.
Okay, gotcha.
Steve, I think I just won today. That's like the guess the secret acronym.
But there's no prize if you are the host and also win. We have to let other people.
You know what though? That might be a fun game to play. We have a wild acronym that we release every Monday, and then whoever comes back with the correct answer gets entered into a drawing, and we'll give away a free car.
I like it.
Yeah. You're paying for the car. All right. So what is a cap?
You didn't say what car. I got a bunch of match boxes.
It's parked right next to the house on the screen.
You pick the category of the prize. I'll pick the specifics of the prize. I got a Hot Wheels for you.
I love it. All right. So in theory, so watch this. In theory, the cap rate is really simple. It's calculated by dividing the net operating income, NOI, by the investment value, or if you're purchasing it, the purchase price, the cost of the investment, whatever that is. And the idea here is that the ratio.
Well, I would like to say the market value, not necessarily what you're purchasing it for. You could say unless you're saying I'm buying it at a cap rate of 12, but you might be buying it at a cap rate of 12, but based on the value, it's a cap rate of 10 because you're buying it at a bit of a discount. Just like you might,
I got you.
so you could buy a property, you could buy $100,000 property for $80,000, right?
Yeah.
So when you say the cap rate of a property is based on the purchase price and not the value of the property, that's
Okay.
yeah.
Well,
There's a number of different ways to use cap rate.
so I'm thinking of this as if I'm buying a property, right? And I'm looking at the cap rates to separate 2 or 5 different investments,
Right.
relatively in the same area. Because this is a really important factor when you're looking at the cap rate. Are you looking at apples to apples? Do you have a house in the hood that, both properties on either side are boarded up, and you're going to have really high maintenance costs, even though they're not in the projections, and, or are these houses like in the same neighborhood, same bedrooms and bathrooms, same type of tenant base, and now we're just determining where that, which is a better investment or not. Right.
Correct.
Here's the problem. In practice, this becomes a place that agents and wholesalers can present, a single or multifamily property in the best possible light. It's like, oh, market rents are way higher than what it's currently rented at, so they jack up the rental price. But what they forget to tell you is it needs $100,000 in renovations, that aren't in the budget to get the rents to that rate. And so it's like lowest possible expenses, highest, cash flow, the whole 9 yards. And when you start digging, what you find is, oh, they undervalued the monthly expenses. Oh, they undervalued a lot of this other stuff. Go ahead.
Yeah, so Steve asked a good question here. How is this measure different from cash flow on monthly rent? And what he's talking about there is how is net operating income, which is one of the things that you use. So you calculate cap by dividing the net operating income by the investment value of the property, and how you come up with, and how that's different than cash flow, or how that's different than monthly cash flow, or return on your money, or ROI, and things like that. Is when you're looking at the cap rate, it strips out financing. It's calculating a percentage on return if you paid all cash.
Right.
So if Josh is looking at a 100-unit apartment complex and he's saying, geez, this is going to cash flow $100,000 a year for me, and I'm looking at a 100-unit apartment complex, and I say, geez, this thing's going to cash flow $250,000 a year for me. We're both right. We're both paying the same purchase price for the $100,000 or for the 100-unit apartment complex. The reason we came up with different annualized cash return or cash flows is because of the financing that we put into place. So cap rate strips that out, because maybe you qualify for a better interest rate than somebody else, or maybe you decide to put more money down, or maybe you have to put more money down, or maybe you know about a different bank that's doing different financing and things like that.
Maybe you're buying it cash. A lot of
you're paying all cash, correct?
From the origins of the cap rate, I mean, they kind of come about because of these large commercial buildings or large, multifamily residential dwellings where you have 100 doors or 150 doors in a community. And, the volume gives you a lot more flexibility or not flexibility, a lot more stability in where the numbers play out.
All right. So net operating income, or NOI, and Steve, what that is it's your gross potential rent. So if this thing was fully rented at market rent 100% of the time, what would that be? And then I take out my expenses, my real expenses and my soft expenses. So taxes and insurance, right? But then also we're going to either apply a maintenance factor and a vacancy factor. We're also going to, if it's a large apartment complex, we're going to take out for the office supplies and the person who's working the desk at the leasing office. We're going to take out legal and accounting and advertising and all those things. So the net operating income is after all the expenses. It's what you would be putting in your back pocket if you paid cash for this property. So if you take the net operating income and divide it into the purchase price of the property, it's what rate of return you're going to be getting. It's the rate of return. It's the cash on cash return if you pay all cash for the property. It doesn't take into account any taxable benefits. It doesn't take into account any appreciation or depreciation of the property or anything like that. It's strictly a cash flow number based 100% on the purchase price and the expenses. Now, here's the problem with cash flow, or here's the problem with cap rate. And a lot of people don't necessarily know or understand this. Josh is probably going to have a different cap rate than I am because he probably is going to use a different vacancy factor than I am. He's probably going to, am I jumping ahead? Okay.
You are, but no, this is, okay. So look, think about it like this. I'm sure you've seen emails with probably less information that's in this spreadsheet where it's like, 1, 2, 3 main sheet. It's amazing. It's amazing. Get it, come get it. And it's like, here's the annual rental income. Don't even have an expense ratio in there, but it's just like, $24,000 a year income. Total cost $160. That's a banging deal, right? Okay. So a 9% cap rate right now, people would kill for in today's market.
Right.
But this is probably where, if you're paying all cash for a property, this is where you got to be, right? You're buying at 115, 45 into it. You got a total cost of 160. And typically when you're doing a refi on like a BRRRR method, it's very, very uncommon for them to take the ARV on the property unless you've owned it for at least 6 months. Usually it's over a year. And then they'll look at the ARV when they're calculating the loan to value, as opposed to the loan to cost, which I'm looking at here, just for the purposes of this conversation, right? This is going to be a loan to cost. So on property A, they're all in for 160, 24,000 annual rent. And there's a big difference between these two properties, and I want to go into it in a second, but I want to see if you can catch it. Okay. $9,600 in expenses, net operating income 14.4. Boom, we got a cap rate of 9%. Pretty decent return.
Right. So what's great about this is we've got two wildly different purchase prices.
Yep.
Two kind of similar capital improvements.
Yeah.
Total costs are, way apart. Disparity in annual income, disparity in annual expenses, disparity in the ratio between the annual income and the annual expenses. How do we sift this out? How do we compare apples to apples? How do we normalize this?
Yeah.
And what we do is we look at the cap rate and we say, oh, these two properties are basically the same. They're similar properties. I mean, they're half a point apart in cap rate, whatever. Maybe that's a big deal to you. Maybe it's not. But it's a way that you can say property A and property B, just at first blush here, are not necessarily wildly different properties in my mind. One is not a wildly better investment than the other. So if you were like,
well, in all likelihood, property A is probably a better investment because it's at a little higher price point with significant improvements. It's probably a pretty decent area.
Yeah.
$2,000 a month and all that, as opposed to property B. How many places can you buy a $45,000 house? I mean, they exist, but it's probably not an A-class neighborhood.
Right.
Even if it's a shell. I did one other sneaky thing here, because this is the areas where you can cheat on cap rate are a couple places. And I got a whole slide on this, but just specifically here, I want you to notice the difference here is $9,600. I mean, that's 40% of the $24,000 annual income. And that's a fair calculation. I mean, that's really what it ends up playing out to be. On a single family, you can expect 40 to maybe 45%. On an aged multifamily, you can expect 45 to 55% in real costs. So we look at property B, the annual expenses are only 30%. And so you got to ask yourself, why is it 30% less expensive to operate, 10% less expensive to operate this property than the other one?
Yeah,
And that's
100%.
yeah, that's why we got to look at the details. And that's what we got here. All right. So there's three major areas where cap rates can go wrong and do go wrong, right? First, you got the income. And I mean, you can break that up into a number of things. What's the source of the rent? Are they quoting you a Section 8, an inflated Section 8 number? Are they quoting you an inflated retail rate? And who is actually in the property and what are they actually paying?
Right. And are they and also are they including laundry income or parking fee income
Yeah.
or garage income? What other expenses are they including in there? So if you're talking about a multifamily, large, multifamily property, there can be major differences with laundry income. If you're talking about single family or small multifamily homes, maybe they're going to rent out that garage for $50 a month or $100 a month, depending on the neighborhood and what the market is. But guess what? For the house, you might have a 3 or a 5% vacancy, but for that garage, they might be calling that $100 a month garage, but you might have a 50% vacancy on that garage.
Right.
So sometimes I strip out additional income, and sometimes I leave it in, or sometimes I will weight it separately because the vacancy factor is going to kind of apply across all income sources.
Yeah.
Usually in the spreadsheet. So if my garage rents for $100, sometimes just to kind of compensate for the fact that it might not be as rented as often as the rest of the house, I'll throw in like $60 or $75 for the garage, just so I'm looking at a more true number for that.
Well, and regardless of what it is, you got to look and see what's there. If they're telling you they have a 4 or 5% vacancy rate, it's probably not true. I mean, it really probably is not true, because that's the number that you go online and you see, and they're like, oh, here's your default number. Okay.
Right.
Especially if it's one unit, a vacancy rate like that, it's almost zero because they've had a tenant that's lived there forever, or it's very high because they lost 1 month of rent last year,
Right.
or a month and a half of rent. So just look closely. Then we get to expenses. Here's what's usually included in the cap rate: taxes and insurance. What? That's like the tip of the iceberg, right?
Right.
You got to include a rental license fee because most municipalities will have them. Association fees if it's in a planned community. You got utility costs if you're covering costs during a portion, like even of a vacancy. There's a month worth of utilities. You've got your management costs and maintenance costs and leasing fees, and you've got to work something in for capital improvements over time, even if it's fully renovated.
Right.
It's going to cost you something.
I mean, I was doing a deal one time. We were looking at several hundred unit property, and we were buying it and putting a new roof on it. But we also factored in something for the replacement of the roof, because that, even though we were putting a $200,000 roof on it, we knew that $200,000 roof was going to need to be replaced at some point down the line. And this is one of those things that you really have to watch. Steve said before about where did he ask it over here about, do you put in anticipated and projected maintenance expenses? Well,
go ahead. Yeah, we'll cover that. Yeah, I mean, you got to have a maintenance expense in there.
So if I'm buying Josh's property, right, and I can see that Josh has only been spending $1,000 a year on maintenance, and he shows me his Schedule E's to back it up, but I figure and I look at and realize that I'm going to be spending $2,500 a year on maintenance. That's called the normalization of the cash flow, and it's the first thing you want to do whenever you figure out what the cap rate on a property is, because I'll never forget the time that I was looking at a mobile home park, putting it together with partners and things like that. And I just could not figure out why these expenses were way whacked out higher than they were. Well, the owner had been running his car through the mobile home park. The park paid for his car for him. and it was something like $9,000 a year. He had this, nice car that just was, and it took me a while of looking at the expenses and things like that to realize it. I backed that out because I wasn't going to be running the property that way. So maybe you're going to do things differently than the current owner. So you want to look at what the current owner's doing, sure, but especially on these expenses, you want to figure out what are they going to be differently. Am I going to be spending the $500 per unit? And you can do it for about $500. Am I going to be doing, or sometimes less, am I going to be doing the $500 per unit expense of submetering the water?
Mm-hmm.
And all the other things like that. So but then I can individually bill back water to the individual tenants. So if that's true, I want to use that as a capitalization cost up front, but I also want to make sure that I'm looking at what my cap rate is going to be going into the future.
Right. So, I mean, when you're looking at all the numbers at the end of the day, you got to make sure that they're real numbers. They're going to be relevant to the property, and that the guy wasn't shoveling his own walks for the last 25 years.
Yeah, that's a great point.
Right. Like it goes both ways. You got to tell the true picture of the story, and every single property is its own story. You got to just kind of walk through it. Okay. Now, instead of cap rate, and Steve Mahler brought this up, instead of cap rate, I much prefer the cash on cash return, like your net cash flow for the year. And first of all, you got to make sure that the numbers are right. Let's assume that they are. Here's this same 9% cap rate property that we looked at before. You're in it for 160, all cash, annual income, 24,000, 9,600, 9% cap rate. Great. We're going to assume we looked at those numbers are right. What's really important here is how much money you have in the deal. So I'm assuming here 20% into the property, 20% down. We're refinancing it, that at the end of the renovation. So we're going to have a mortgage of like 123 or something like that. We got 35,000 in cash, plus 32.5 in down payment, and then another $3,500 in closing costs. So we're adding expenses here because they're real. But when we look here and we add in the PMI or the principal insurance, principal and interest payment, gee whiz, the principal and interest payment, we're reducing our cash flow to about $500 a month. But, we're talking almost a 20% return on the money that we actually have invested in the property. That's humongous.
Right. And what's important to remember is that's your cash on cash return. That's not even your total return. Right. Because you're going to be getting, we got to do a show sometime, Josh, in showing and actually going through the numbers, because your first year, you're going to appreciate maybe 2, maybe 5% in value. So, that's going to bump that up a little bit there too. But so maybe that gets that up to like 20.
Right.
But you're also going to be paying down a mortgage.
I know.
And so if you look at your cash and the equity buildup, and your equity is going to build up a little bit because of appreciation, maybe only 1 or 2%, maybe as much as 5 or 7%, depending on how good the year is. So you're going to get 1 or 2% build up in equity because of the value of the property increasing, but you're also going to be paying down that mortgage every month. And that's $200 to $300 a month. Well, you're getting $500 in cash flow out of the property, but you're also getting $300 a month in principal reduction. Guess what? That means your actual return on this property, your actual true fully amortized return is 25 or 30%. It's ridiculous. So I've done hundreds of these deals with partners over the years where I got them to leave some money in the deal, and they were like, geez, Judah, do we split this? Are we even making any money? Yeah, I know you're tying up 10 grand in this thing, but we're splitting, you're making a 15% return on your money, and I'm making 15% just for putting this thing together and overseeing it. So when cap rate tells one story, cash on cash tells another, fully amortized return tells a different story. And maybe those three numbers are widely different. Maybe there's a common ratio that you find between them. Maybe there's some disparity on a deal for some reason because of different financing you got, or you left a little bit too much money in it. But when you look at that 18% cash on cash return, and you compare that to the stock market, that's not like stocks going up 18% a year. That's like a stock paying an 18% dividend a year. You tell me what
Well,
stock
and
out there is paying
yeah,
an 18% dividend.
the one thing that you have to look at that's very important is that these cap rates and the cash on cash returns, they have a relationship there. And it's almost like pre-leverage, post-leverage relationship. But at the
Right.
same time, you also have diminishing returns on leverage. And it happens somewhere at like the 6 or 7% range, where the essentially your your cash flow is getting eliminated by the principal and interest because of the ratio there. So that's kind of where I look at it and I'm like, yeah, I got to bail on this. It's not
Yeah.
going to make sense as an investment when you don't see a return from the leverage that you have in the property. You're probably paying too much.
Yeah, 100%. Yeah, I think that cap rate is important. I think that cash on cash return is important. And when I look at these cash on cash returns and I talk to people about them, one of the things that people say to me quite frequently is, yeah, but I'm getting 18%, but don't forget, I'm also going to have to worry about, plunging toilets and turnovers and, what happens if I have a vacancy? No, this is 18% after we've factored in all of that stuff. Now,
That's right.
maybe you experience a 7% vacancy and you were only budgeting for a 5. Maybe the maintenance on the property is $3,500 a year and you were only expecting it to be $2,500 a year. You're
Mhm.
going to get better at this. But the point is, as long as you're being somewhat reasonable in your numbers up front, and as long as you've got a nice, healthy cash on cash return like that, even if you fail for a year or two,
Right.
maybe oh my goodness, we totally screwed this property up. We're breaking even for the first year or two. Once it's back on track, this thing is a money pump where it's just pumping out money to you all day, every day. And this is why Josh and I have made the majority of our wealth in real estate. This is why Josh and I love doing real estate and want to encourage as many people to do real estate. But we also want to encourage you to dive deeper than just looking at cap rate and getting stuck on cap rate, because it's a number that you're going to use. Steve, we got two Steves going back and forth here earlier. Steve Mayer earlier said that he usually uses 15% for vacancies, repairs, and maintenance, and CapEx, capital expenses. And I have people ask me all the time, hey, they're in Lancaster, what are you guys using for CapEx expense? I don't know. When something needs broken, are you going to do the Band-Aid job, the normal job, or the gold-plated job? I mean, are you? How good are you at contracting and all these other things like that? People come to me as a property manager and expect me to have a lot of answers. I have answers that I would give my investors and that I would give my partners, but a lot of this stuff is very subject to what you're going to use. By the way, I think 15% is a good number, because when
Yeah.
you stack on top of that property management,
Mhm.
your Slate House only charges 6 to 7%, but a lot of property management companies charge 10%. So when you would stack 10% on top of that, you're looking at a 25% all in soft cost expenses. And I think that's where you should be. When
Yeah.
you analyze a property, you should be looking at anywhere from a 20 to a 30% expense ratio for maintenance, repairs, vacancies, and property management. If
Yeah.
you're using something wildly less than that, you are just lying to yourself and you're setting yourself up for a hurt. The other thing is, Steve, you should be using a property management expense if you're managing your own properties,
Yep.
because your time is worth something. So now you're getting paid as a property manager on this deal, and you're also getting paid as an investor on this deal. Just
Yep.
like you should factor in and only do deals based on contracting costs, because because even if you're going to be the one swinging the hammer a lot of times, because you deserve to get paid for the sweat equity that you're putting into the deal. If it's only a deal because you do the work, it's not actually a deal. If it's only a deal if you manage it yourself, it's not actually a deal.
Well, and Judah, think about it like this. Imagine if you, if you're a contractor and you're working on your own investment property. Well, you still have to put food on the table. You still got to pay your existing bills. So what are you going to do? You're going to stop working at the other place? Or are you going to put the investment property on your nights and weekends project? And instead of taking 2.5 months to get the place rent ready, you took a year. Like nobody's saving money there.
Right.
You got to value your time.
Yeah, you got to factor it all in and look at all those things. Listen, guys, Josh and I, here we are at the end of another jam-packed show, and we love bringing you guys content every day. One of the ways that we're going to elevate the content that we are bringing to you is by doing Facebook challenges, and our first one is going to be starting next week on Monday. You want to go to buildandgrowwithrealestate.com, buildandgrowwithrealestate.com, get registered. We're going to be doing this on Facebook. We're going to be coming to you through a live Facebook channel and a private group that only people who have registered can do. Now, registration's free. Anybody can be a part of this, and this is going to be our first one. And, we're going to be kind of brutally hard on some people, telling them the steps that they need to do to take action. And guys, as we roll this out and as we build this, we would love you guys being brutally hard with us and telling us how we can do these better, because we really think that the boot camp method is over. I've oftentimes gone to boot camps and learned a whole lot from that. I have gone to local meetups and other things like that. This is going to feel much more like a local meetup. So when we do this daily show, it's Josh and I kind of talking at you and delivering information, right? But meetups are good because there's times of collaboration and meeting and gathering and talking and sharing and things like that. And that's a lot of what's going to happen. There's going to be some online collaboration with these Facebook challenges, or you can come and show up and kind of be a little bit shy, just like you do at the meetups as well. So this is going to be more of a meetup feel than a show feel. And I'd really encourage everyone to get registered. And you just go to buildandgrowwithrealestate.com. It's 5-day Facebook challenge, flipping houses without cash, credit, or criminal behavior.
Yeah, it's awesome. We're going to be back here again tomorrow, rocking and rolling at noon. If you enjoyed today's show, don't forget to like and share. We really appreciate you guys being here. Had a good amount of people on the show today. So thanks a lot. We really appreciate you guys. We'll see you back here tomorrow. Until then, go make some money. See ya.
See everybody.